Thank you, Anthony. It's a wonderful introduction to what I also want to say today. I think that the theme of my presentation is can a monster be tamed? And I think we all know what the monster is, the inflation monster. It's been a massive surprise globally, and it's been synchronized that we've seen a massive increase in inflation rates in all developed countries and even in South Africa. You look at what's happened to the US 30-year mortgage rates from as below 3% 6-7 months ago to almost 7% now. So a massive increase in mortgage rates. At the same time, you've got mortgage debt at record levels, the green line. The yellow line reflects the service cost of it, and that's because that hasn't increased yet, because it's typically they've fixed the rates for 5 years. So that is a refinance risk that's waiting to happen. As rates stay higher and these 5-year contracts come to an end, you see that interest service cost going up. Now, this is an interesting graph. The green line is gross margins of the top 1,000 companies in the US. The yellow line represents the consumer sentiment in the US. And you can see the good correlation between the two. Now, we've seen a bit of a sell-off or quite a sell-off in US markets, and most of it's been driven because the P of PE has fallen. So there's been a de-rating. The next risk for us is that because of this low consumer sentiment and the high margins, that you actually see margins coming down and that you see earnings surprising on the downside. And we've already seen a couple of that coming through. Lower earnings with a lower PE could put further pressure on the market. Even after the fall, the US market is still not cheap at a 20 times price earnings ratio, so we still think there is de-rating risk there as well. Part of the reason there's so much stress in the world is a very strong dollar. Now, it helps the US because they're importing deflation, but they're exporting inflation to the rest of the world. So it also puts further pressure on the system. Now, for me, this is a very important slide. And if you remember one slide of my presentation today, this is the one. So this is a graph that looks at the difference between the earnings yield of the US market and inflation rates. Now, typically, you want to earn a real return from equity markets. So on average, that real return has been about 2%. There's been 5 times in history in the last 60 years where that has gone below zero. The first time was in the 70s. Well-induced inflation, it went negative, and you saw a crash in the 70s. The second time was in the early 80s. It went below zero. It was the double-dip recession at the time. You saw the markets selling off. The third time was in late 87, and we know the October 87 crash. That was the third time it went below zero. The fourth time was in the end of 2000. It was the dot-com bust, and you saw a big sell-off. Next one, global financial crisis, 07. We know what happened there. And the last one is the most negative. This has gone in the last 30 years. This is not going to resolve overnight. I mean, for that to move back to a long-term real rate of 2%, either your inflation has to come down by 4%, and it looks like that's what the market is pricing in at the moment, or earnings have to grow almost 80% from a current 5% earnings yield to get to a 9% earnings yield to get there. As I've said, we think there's going to be pressure on earnings, so it will have to come from inflation dropping. And I mean, if you look at the last 12 months, the graphs every month of what the inflation expectation is 12 months out, you just see a continuous drop-off. And every month, the drop-off just starts at a new level. So the big risk to global equities and to the US specifically is that inflation is stickier than expected. And that's what's been experienced up till now. This is South African interest rate expectations. The market is pricing in that interest rates are going to go up by another 2% and normalized at a prime rate of about 11.75%. If we look at our bonds in South Africa, very attractive real return relative to US long bonds. and also in terms of just its own nominal terms. I mean, you can buy a SA long bond at almost a 12% yield. If you say over the next 10, 15 years, inflation averages at 5%, that gives you a real return of 6 to 7%. That is almost an equity-like risk return that you're getting from investing in a government bond. So for the opportunity fund, this is the highest weighting the fund's ever had to bonds. It gives a very nice floor to your return, and positions the fund very well for good long-term real returns. Now, just reflecting on the returns, we're very pleased with the fund's performance, especially year to date. The fund is up 4% year to date, and as you can see, the market down 10% year to date. The average medium equity fund down 5%, so we're very pleased with that performance. If you look at the longer term numbers, 10% since inception, it's actually outperformed the market, outperformed low, medium, and high equity average. So we're very pleased with the fund's performance, and that has come despite some hiccups, quite a lot of hiccups. A lot of mistakes made along the way, but at least in the long term, that plays through the fund's performance. It's one thing to get returns, but one has to look at it on a risk-adjusted basis. This is a graph where on the vertical axis, that's the return since inception, and our horizontal axis, the return per unit of risk. So you want to be as far to the right on that graph as you can, and as high as possible on it. So we're pleased to see that orange dot represents the net group opportunity fund. Sorry, it's wrongly colored. So the orange dot is actually the net group opportunity fund. Where has this performance come from? So our stock picks have really come through nicely. Tungela Resources, BAT, Royal Bafokeng, and also our exposure to the US dollar with the rand weakening against the dollar. What's pleasing is to see that our detractors have all been below 1% detraction. And I mean, you look at Naspers as top detractor. If you remember a year ago, that was over a 6% position within the fund. So for us to only detract 0.6%, given what's happened to it, just shows the benefit of us having hedges on some of our larger positions. So Naspers now down to below 2% weighting, and we're quite pleased how we've managed the risk associated with that investment. So just the market outlook for the rest of the year. High inflation, as I said, the risk is that it's sticky. We've got synchronized global monetary policy tightening. There's global recession risk if we're not already in one. Consumers are under pressure globally, as we've seen with the consumer sentiment. We still expect earnings downgrade. SA economy is under pressure. We expect further rate hikes locally. I don't want to repeat what Ant said, but I mean, we see quite a bit of value in the SA equity market after the sell-off. And we think bonds continue to offer very attractive real returns. So looking at the asset classes, we think SA bonds looking cheap, emerging market equities looking cheap, and SA equities. We think property is now back to the fair bucket. SA cash after the increase in short-term rates also looking fair, even getting close to the attractive side. US bonds have moved from expensive to fair, and there are actually select US bonds that's starting to also offer value. Developed market equities, fair, and the rand after the sell-off is somewhere between attractive and fair, probably getting closer to moving to the attractive bucket. We still think developed market bonds ex-US is expensive. Developed market cash don't compensate you for the risks associated with it. And US equities, as I said, we're still worried about the valuation. So how's the fund positioned? You can see from December 2021, the significant reduction that we made in equities as we became worried about valuations. More recently, within that, we rotated into lower beta shares. More recently, we've started increasing the beta of the portfolio and the composition of the equities that we own, because, as I said, we think there's value. But what we've also done is we've moved quite a bit of our SA equities into offshore equities. And that's after the significant sell-off that we saw in global markets. So you're able to, with the changes in Reg 28, increase your foreign exposure, and so that way diversify the portfolio and increase the quality of the portfolio. And then you can take a separate decision on the currency. How much of that currency do you actually want to hedge back to South Africa or not? So it's almost created a new asset class that you can have hedged equity. So you can have a foreign asset actually priced in rands. So this reflects the top 10 equity positions. You'll see that we think banks are offering you very attractive valuations, and it's actually done fairly well for the fund, despite Thungela's strong performance, still in the top 10. And you'll see some global names appearing within the fund. Unfortunately, Meta is one. They reported results last night that wasn't taken well by the market, but we still see this as a very attractive long-term quality company. Google also in the top 10, and then you'll see Naspers now the 9th position, whereas it used to be the number 1 or 2. Just in conclusion, as I said, recessionary risks have increased. We expect to see earnings downgrades, negative surprises. There's still a lot of geopolitical tensions, and it's intensifying also, or that intensifies the cost pressure on consumers, and it threatens consumers' livelihoods. So this sort of increased closing of borders also introduces inefficiencies into the system, which increases the inflationary pressures. SA equities, we find select value. SA bonds offering very attractive nominal and real returns, especially on a risk-adjusted basis. It provides a very good floor to your returns. So if you think about it, about a third of the fund is invested in bonds, offering you close to 12% return. That provides a nice floor. Your equity side, we have a basket of high-yielding equity investments, which again add to that return. And then we've got our basket of structured notes, which have got a yield to maturity of over 20%. So that combination provides that the yield at the portfolio level is 8.2%. So that's above what one can earn on cash, yet we've got some growth assets within the portfolio, and we've also got some capital protected instruments. So our structured note basket makes up about 6.2% of the portfolio. The yield to maturity is 21%. It's very well diversified. It's spread across 21 notes, so we're not taking a specific risk on just one note, and it's spread on 14 assets, over 14 assets. So very attractive. So we're quite happy with the fund's positioning. We think the Opportunity Fund has a mix of capital protected instruments offering decent yields. We've got a high weighting towards bond, and we've also got exposure to attractively valued local businesses. So despite the doom and gloom and the concerns that I've raised early on, I think in South Africa, investors are fortunate that the asset classes that you use to build up a balanced portfolio actually give you very good returns. And now is the time to structure a portfolio for very good long-term returns for your portfolio. So don't just be completely, I hope I haven't scared you so much that you've just go all to cash. We do think that in this environment there's still very good opportunities. Thank you. With that, I'll hand over to Junaid.